The Northeast didn't become expensive overnight. It earned that reputation slowly, brick by brick, decade by decade. For most of American history, this region set the price of housing rather than followed it. Boston, New York, Northern New Jersey, Southern Connecticut. These weren't just cities. They were command centers. Finance, shipping, manufacturing, education. When money moved through America, it passed through here first. And when demand stayed strong long enough, prices learned a dangerous habit. They stopped falling. In the 1970s, while much of the country still built outward, the Northeast ran out of room. Not land exactly, but permission. Zoning boards grew powerful. Historic districts expanded. Environmental reviews multiplied. Every new home required a fight. And scarcity. Scarcity is the most reliable fuel for rising prices. By the 1980s, something else happened. Jobs consolidated. Wall Street exploded in influence. Universities grew into billion-dollar institutions. Corporate headquarters clustered tightly. People followed opportunity. And housing followed people. Upward. Then came a subtle shift most buyers didn't notice. Homes stopped being shelter first. They became assets. Not in theory. In behavior. Owners held longer. Developers built fewer starter homes. Investors began to circle quietly. Prices no longer reflected wages alone. They reflected confidence. Confidence that demand would always return. Confidence that downturns were temporary. Confidence that this region was different. And for a long time, it was. Even during national housing slowdowns, the Northeast bent but rarely broke. After the early 1990s recession, prices dipped. But they recovered faster than most regions. After the dot-com crash, they paused. Then climbed again. Each cycle reinforced the same belief. You don't wait for prices to fall here. You buy before they rise again. That belief became institutional. Banks underwrote it. Appraisers baked it in. Buyers repeated it like a rule of physics. And rules, once trusted long enough, stopped being questioned. Then came 2008. The collapse that was supposed to change everything. Across the country, prices fell sharply. Entire subdivisions vanished in the Sun Belt. Foreclosures flooded the Midwest. But in the Northeast, the damage looked contained. Yes, prices dropped, but not like elsewhere. Not enough to shatter the myth. The narrative survived. If you can hold on, you'll be fine. And many people did. After 2012, something historic happened. Interest rates fell to levels no previous generation had experienced. Money became cheap. Dangerously cheap. Suddenly, a $900,000 home didn't feel outrageous. Monthly payments mattered more than price. Buyers stopped asking, "Is this worth it?" and started asking, "Can I afford the payment?" That single shift changed everything. Prices didn't rise because incomes surged. They rose because borrowing became effortless. And in a supply-restricted region like the Northeast, that effect multiplied. Every extra dollar of credit chased the same limited number of homes. Then came the pandemic. And with it, the most misunderstood housing surge in modern history. People didn't just want space. They wanted certainty. Low rates felt permanent. Remote work felt permanent. Urban demand was supposed to disappear. So buyers rushed. Not cautiously, urgently. They waived inspections. They bid against themselves. They treated appreciation as guaranteed. And prices responded accordingly. By 2022, Northeast home values sat far above any historical trend line. Not slightly above, far above. But here's the part most people miss. Markets don't break because prices are high. They break because the reason for high prices disappears. And quietly, very quietly, that reason has been eroding. Interest rates didn't just rise. They reset. Remote work didn't expand. It narrowed. Migration didn't reverse fully, but it slowed. And affordability, once ignored, returned as a hard limit. The Northeast has always relied on one unspoken assumption: that there would always be a buyer willing to stretch further, pay more, accept less. But what happens when that buyer hesitates? What happens when confidence weakens? What happens when holding becomes harder than selling? That's where this story turns. Because history doesn't repeat itself, but it does keep score. The structure was simple: high-paying jobs, limited land, strict zoning, cultural attachment to ownership. Together, they formed a price floor. A floor that rarely cracked. But floors don't collapse all at once. They weaken first, quietly. The first pressure point is affordability. And this time, it isn't emotional. It's mathematical. In the early 2000s, the typical Northeast household spent roughly 25 to 30% of income on housing. Even during bubbles, that ratio mattered. It acted like gravity. After 2020, that ratio broke free. By 2023, many buyers faced housing costs, consuming 45 to 55% of gross income. Sometimes more. And no market can sustain that indefinitely. Hear why that matters. In previous cycles, buyers stretched temporarily. They expected raises, promotions, bonuses. Income growth was assumed. This time, wages didn't keep up. Not even close. Finance salaries plateaued. Tech hiring slowed. Healthcare stabilized instead of expanding. The Northeast didn't lose jobs dramatically, but it stopped accelerating. And housing prices require acceleration. Stability is not enough. The second pressure point is interest rates. Not just their level, but their permanence. For over a decade, buyers were trained to believe low rates were normal. That central banks would always intervene. That borrowing would always be easy. But history disagrees. From the 1970s through the early 2000s, mortgage rates averaged far higher than today's buyers ever experienced. The post-2008 era wasn't normal. It was an exception. And exceptions create bad assumptions. When rates reset upward, Northeast buyers didn't just lose purchasing power. They lost flexibility. A household that could afford an $850,000 home at 3% can afford roughly $550,000 at 7%. That gap doesn't disappear. It waits. Sellers noticed something first. Showings slowed. Offers thinned. Days on market stretched. But price cuts felt unthinkable. Because sellers weren't reacting to the market. They were reacting to memory. They remembered neighbors selling for record prices. They remembered bidding wars. They remembered certainty. Memory is powerful. But markets don't price memory. They price current demand. The third pressure point is mobility. And this one is uniquely dangerous. Millions of Northeast homeowners are locked into ultra-low mortgage rates. 2%, 3%, sometimes lower. Those rates act like golden handcuffs. Selling means trading certainty for risk. Moving means doubling monthly payments. So people stay, even when they want to leave. At first glance, this seems supportive for prices. Fewer listings, tighter supply. But there's a hidden cost. When people stop moving, markets lose liquidity. And illiquid markets don't adjust smoothly. They gap. Instead of gradual price declines, you get stalls, followed by sudden drops when pressure finally releases. The Northeast has seen this before. In the early 1990s. Back then, job losses triggered delayed selling. Owners waited. They hoped. They resisted price cuts. Then layoffs deepened. Relocations became forced. And prices fell not slowly, but sharply. History doesn't repeat. But behavior rhymes. The fourth pressure point is demographics. Quiet, unavoidable, under-discussed. The Northeast is aging faster than most regions. Baby boomers dominate ownership, and many plan to age in place. But plans change. Health changes. Family needs change. Downsizing is no longer optional for many. It's necessary. At the same time, younger buyers face record debt. Student loans returned. Childcare costs surged. And household formation slowed. That creates imbalance. More future sellers. Fewer flexible buyers. The final pressure point is psychology. And psychology breaks last. For years, owners believed one thing. If I don't sell now, I can always sell later. That belief holds. Until it doesn't. Once sellers sense prices may not recover quickly, behavior flips. They rush not to buy, but to exit. Not all at once, but enough. That's when floors don't crack. They give way. The Northeast hasn't reached that moment yet. But the signals are forming. Longer listings. More incentives. Quiet price reductions masked as seller credits. These are not headlines. They are whispers. And whispers always come before the break. Open houses feel emptier. Agents use softer language. Seasonal slowdown. Waiting for the right buyer. Still strong long-term. But markets don't move as a group. They move through people. And some people break before others. The first group is recent buyers. Not all of them, but enough to matter. Anyone who bought in the Northeast between late 2021 and mid-2023 paid a premium for certainty. High prices, low rates, maximum confidence. Many stretched, not recklessly, but optimistically. They assumed time would solve everything. That appreciation would cushion risk. That refinancing would always be possible. Then rates stayed high. And time stopped helping. These owners don't panic immediately. They hold. They adjust spending. They wait. But life doesn't pause. Job changes happen. Families grow. Relocations become mandatory. When selling becomes necessary, instead of optional, leverage disappears. And the market senses it. The second group is small investors. Not institutions. Individuals. Duplex owners. Three-family landlords. Short-term rental buyers. For years, the math worked. Low rates masked thin margins. Rent growth covered mistakes. But insurance rose. Taxes climbed. Maintenance costs exploded. Meanwhile, rent growth slowed. And in some Northeast metros, it reversed. Suddenly, cash flow turned negative. Not catastrophically, just enough to hurt. Investors don't wait for pain to deepen. They sell early, quietly. And when investors sell, they compete on price, not emotion. The third group is move-up sellers. And this is where momentum breaks. These owners don't want to sell. They need to. Growing families, elder care, work relocations. They expected to sell high and buy higher. That math no longer works. Selling means losing a low rate. Buying means doubling payments. So they delay. They list half-heartedly. They withdraw listings. But eventually, decisions become unavoidable. And when they do sell, they undercut. Not dramatically, but strategically. One lower comp resets expectations. Another follows. Then another. This is how prices actually fall. Not through collapse. Through recalibration. The most protected group. Long-term owners. Those who bought before 2015. Before prices detached from income. Before rates rewired behavior. They have equity. They have options. They can wait. But here's the paradox. They don't set the market. Marginal sellers do. Markets are priced at the edge, not at the center. And the edge is where pressure builds. Neighborhood by neighborhood, the pattern emerges. Luxury softens first. Entry-level freezes next. Middle markets wobble last. This isn't theory. It's historical. In the early 1990s, Northeast downturn, high-end suburbs corrected sharply. Starter homes stalled. Middle-class neighborhoods adjusted slowly, but meaningfully. The same structure is forming again. Different causes. Same mechanics. And through it all, one belief lingers. This region always comes back. It probably will. Eventually. But timing matters. And cycles punish those who assume timing doesn't matter. The danger isn't collapse. It's complacency. Because when everyone believes the floor is solid, no one looks underneath. Markets don't collapse because everyone panics. They adjust because reality finally outweighs belief. For years, the Northeast lived on a simple assumption. Prices may pause. They may wobble. But they don't come down. That assumption was never a law. It was a habit, formed during decades of growth, credit expansion, and limited supply. Now the habit is being tested. Not by fear, by arithmetic. When we say prices can't hold anymore, we don't mean collapse. We mean gravity returning. Historically, Northeast housing corrections follow a familiar pattern. They don't overshoot dramatically. They retrace. In the early 1990s downturn, many Northeast markets gave back 10 to 20% in real terms. Not overnight. Over several years. After 2008, the region avoided the worst. But even then, certain suburbs and luxury segments fell meaningfully before stabilizing. This time is different in one key way. Prices rose faster than incomes ever did. That gap must close. There are only two ways it happens. Prices fall, or incomes surge. Income surges aren't coming. Not at the scale required. So the adjustment happens the quiet way. Nominal prices flatten. Inflation does the work. Real prices decline. Sellers offer credits instead of cuts. Buyers negotiate repairs again. Appraisals start to matter. This is not a crash. It's a normalization. Who comes out strongest? Those with patience and flexibility. Homeowners with low rates and stable income can wait. They don't need to react. They let time absorb volatility. Buyers with strong cash positions gain leverage. Not to lowball, but to choose. And those who must act, relocations, downsizers, over-leveraged owners, set the new comps. Quietly, the worst decisions happen at extremes. Buying out of fear of missing out. Selling out of fear of missing liquidity. Smart decisions look boring. They always do. They involve conservative assumptions, longer timelines, acceptance that homes are shelter first, assets second. The Northeast will remain desirable. Its universities won't vanish. Its hospitals won't relocate. Its cities will continue to attract talent. But desirability doesn't eliminate cycles. It just softens them. Every market that believes it's immune eventually learns the same lesson. Immunity isn't permanent. The floor doesn't disappear. It moves. And those watching closely will notice it shift before the headlines ever catch up. Because by the time the story becomes obvious, the opportunity and the risk has already passed.